Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with David Hall of YFM Equity Partners to talk about the British Smaller Companies VCTs. Hey David, welcome back to the studio. So we're talking about the British Smaller Company VCTs. What are they? What do they aim to do for investors? What differentiates them?
Hi, Jonathan. Thanks for inviting me back. So British Smaller Companies Venture Capital Trusts, about 400 million under management now in a diversified portfolio of assets. They were in the first wave of venture capital trusts that were launched, so they date back to end of the 1990s, early 2000s. Next year is coming up to the 30th anniversary for VCTs as a whole. And they were in the first launch. So they've had investors with them for a number of years, investing in early stage, small British businesses for a period of time. Last 10 to 15 years, focused a little bit more on enterprise software, which I'm sure we'll talk to you a little bit more about.
And so they're managed by YFM Equity Partners. For those who aren't familiar, who's YFM?
Well, YFM, the Y in YFM was Yorkshire originally, so which is where the business started, although I'm a Lancastrian by birth. Worked there now for almost 25 years. I think the Yorkshire people are almost used now to having a Lancastrian there. I'm the chair of YFM. I was CEO for a number of years, but now currently chair. YFM has a 40-year history in total, so a long time, but always serving the same market, which is the unquoted investments and small businesses through all of its time. And when we started life, there was no internet and mobile phones didn't exist. And the first investment that we made was in a coffee wholesaler. And the most recent investment we've done is in a workflow tool management business, which shows, I guess, how we and VCTs adapt over time to the investment opportunities.
Interesting. And so on that note, what companies are the VCTs looking to invest in? And are you more of a generalist or a sector specialist? You mentioned enterprise software.
Yeah, I think we've always said we were specialists in small businesses to start off with. And I think we've had to refine that over time because small businesses have particular needs, particular management teams develop and that sorts of things. But also there's been, I guess, a specialism to a degree in the types of businesses and the types of services. So we've always invested in business services. That's morphed now to business services being provided through application software, which is effectively, I think we think of it as like the iron and steel for the 21st century. It's sort of most businesses now need that, and it's the lifeblood of them to help them work sort of faster, smarter, quicker, better. And yeah, we'll talk to you about how we'd provide the diversification within that. But it's effectively providing those services to a whole range of different sectors and also geographies.
And any particular stage?
Yeah, we tend to sit, as I think quite a lot of VCTs are. I'm not very good with the letters. Some people talk about Series A, B, C, and D. But generally speaking, the stage at which we get to see businesses is they've started to get going. They're usually run by a couple of people at that time, usually one of whom is selling something and the other person's making it. And one of them is doing the numbers because the other one doesn't want to. And they've developed a product or service that fits a market, usually turning over £1, 2, 3 million with about 20 to 30 to 40 people. And what they need to do is transition themselves. So they think usually that they come to us that they want to scale. What they need to do normally is just prepare themselves to be able to scale and then scale. And we tend to go in at that bit to help them through that transition and then stay with them as they start to go on the scaling journey.
So how do you find these companies? And once you find a good one, how do you win the deal?
It helps, I think, having been around for 40 years. It helps the fact that we are national. I said the Y in YFM is where we started, but we've got offices now throughout the UK. We've got 5 different offices, in total, 60 staff. So there's a long history, which helps, a long history of backing those businesses, which is helpful. But we've also helped ourselves as well. So we have now a direct origination team. The way that we engage with businesses now is very different to it was 30 years ago, and even was 10 years ago. We'll engage with them, before they're coming to raise capital. Sometimes we help them a little bit along the way before they get to us. And those things is to try and show us a little bit about the sort of partner that we could be. And as a result of that, that generates sort of transactions for us. We have a detailed origination team, and we do everything now from data scraping when you're looking at that. So you're looking at where are the fast growing businesses, where are they based, what sort of people are they in. So you want to scrape LinkedIn because that's where, you'll see people advertising for space. It's a very different sort of approach. And latterly, as well, you've also got a very increasing ecosystem of early stage investors. So the businesses are more used to taking capital externally than they've ever been before. And there's a whole network of people with whom you have to embed yourself. And it's that approach that means that, so over 2/3 of the transactions that we've done in the last 3 years have come effectively through direct origination.
And so turning to companies, any recent examples of companies you've backed in the VCTs?
And there's always good examples. And it's been an interesting period because in terms of our raise for last year that we undertook, we saw that the pipeline was filling. And actually, we've seen that translate into investment activity, where our current level of investment activity is, I think it was like 40 million investment in the first 5 months since the last fundraise. And the types of businesses that we're seeing there, are similar to previously, which is good. Enterprise software businesses, capital efficient. A couple of good examples, a business called Fuuse. Fuuse is a data management system for people who try to run electronic charging networks. So again, it's about data management. It's about collection of data, analysis of data, provision of data. Similar idea is a business called Ohalo. It is how we pronounce it. It's actually spelled Ohalo, but we call it Ohalo now. And Ohalo is a tool for managing and finding unstructured data. So lots of organizations have, just collect things in all sorts of shapes and forms throughout the whole of their business, in every sort, whether it's coming through a social media, a bunch of emails that you've done, series of reports, however you've done that. Large corporates now are forced to look at how they manage and control that data. And again, it's a system that looks at the whole of that unstructured data and be able to put it into a sense where you can pick and choose it and manage it on a good basis. So those sorts of businesses, again, are both very recent transactions for us, but are sort of reflective of the types of investments that we're making.
And turning to the existing portfolio, some of the more established holdings, any particular highlights? How are they performing?
There's always highlights, I think, in the portfolio. Some of the highlights that we tend to look at, and we sort of overlook businesses that have been in there for a while and are still growing at 40% because it's easier to look at the new ones, which are growing at 100% at small numbers. But some of the faster growing businesses that we've seen recently that we've had now for a number of years, business like SharpCloud, which is another data management tool, again, effectively for finding the single version of truth within organizations. That business is reaccelerating its growth, and a reacceleration of growth we're told, is rare, but it's that sort of thing is something that you really support. See a business called ACC, which is a bit less techy, and that's currently organizing flights. It's a charter a business. Probably underserving it to call it just a charter business, but it provides at very short notice wet and dry leases, as they call it, so with pilots and crew and not. That's currently helping evacuate people out of Lebanon at the moment, and that's growing significantly. And we have an investment, which is usually one we always have to talk about, called Matillion. Matillion's been in the portfolio for a while. We top sliced some of the return on that. So we've banked about 4 times return on the total investment so far from that, but we've still kept a residual holding in it. That business has got a really interesting and exciting 25 coming as it evolves into its next product, which, if you get a business which is turning over nearly $100 million, which has got a chance to expand, at a significant rate. That's a really interesting time. So it's like a second infusion of life into it.
Interesting. We've, I think, followed Matillion for a number of years now.
I think we have.
Manchester's big success story, I'd say. So to what extent do you get involved in some of these companies? Is it a case of finding a great management team leaving them to it, or are there things that YFM like to get involved with?
It's an interesting question because we obviously want to back entrepreneurs and strong entrepreneurs. So you need people who've got the vision and the ambition. We are providers of finance to them, which is one of the tools that they need. One of the things that is a real privilege that you get working in the industry that we do is you get to then see those journeys over many different times in many different ways across many businesses and how they expand and grow. That's the knowledge that hopefully we can help to bring to those businesses where many are entrepreneurs and CEOs who are first-time entrepreneurs, or and even as Matthew, if you talk to Matthew at Matillion, he would say this is the first business turning over nearly $100 million that I've ever run. So what we can help to do is put networks around them, put support systems around them, try and help smooth some of those bumps in the road, as we call it, which is another way of actually just saying we're trying to manage away the risk as well at the same time. So what we can bring is the experience that we have of having 40 years of investment across a range of small businesses, all going through different expansions at different rates, also through lots of different economic cycles. So, managing your way through a downturn is very different to managing your growth. And I think if we as an investor can at least put the hand on the shoulder and go, it's okay. These things, you can get through this. Here's the experience we've done before. If that then helps give the entrepreneur what they need to make that next step, that hopefully helps them further their value creation.
And turning to exits, it's been a pretty difficult time for venture capital past couple of years. Exits have been few and far between, I'd say. Any recent exits in your portfolio?
Yeah, well, I mean, interestingly, I suppose I contrast 23 and 24. So 23 we did exit a few businesses, and they were businesses where at that point we have quite a dedicated portfolio team and quite resource heavy. And what that means is that where businesses go a bit off track, we can kind of help them put in new systems, put in operational infrastructures. So last year was really the businesses that had been through that sort of phase where we'd be able to help were the ones where we thought we'd done that. There might be some more growth still to come in it, but we wanted to sort of exit those businesses. And they all produced good returns, high, multiples of capital where the multiple wasn't one. So it's like, a decent return where they'd been through a bit of trial. That's kind of what we put on the market last year. This year, we had one or two of the older assets that we'd had been a long time, but which we did good returns in them that were saleable. And that was, so what buyers are looking for in, like you say, is what people think is a difficult market, but they put more value on things than on certain aspects of businesses than they do at other times. So they will weight heavily things like high capital efficiency, high product market fit, high retention rates of customers. And actually the result of those is you can still achieve exits for those businesses because they're also delivering growth rates. And this year we sold Displayplan, which had delivered that, which is nearly a 10 times return. And also we had a business that actually had two parts to it, a business called Ketech. It had a business which provides rail information systems, and had another business which was actually chemical-based, which was used in defence industries. And we sold the defence industry business off, which had a different profile in terms of future growth, but that still delivered a near 2 times return on the whole investment. So I think you've got to pick and choose and know exactly what the buyers are looking for when they're being selective, and then try and manage the investments, which is one of the things we can do to help those entrepreneurs in those situations achieve the exits that they're looking for.
So David, I guess for every success story there are failures, and turning to risks. Just how risky is your VCT, would you say? And are there any steps you can take to help manage some of these risks?
Well, I think the risks generally within VCTs are set ultimately by the government requirements, because there's a tax break that people get. Before that, the government wants certain things. So they want they want the money to be invested in early stage, high growth businesses. So, and that carries risk. And I think you've just got to accept that. And our VCT is therefore, in exactly that position. I think the way that you manage the risk is in part some of the things we talked about. We have a a big investment in a portfolio team, which means that we limit the number of assets that they'll manage so that they, which is 5 or 6 each, in order to be able to give the time that's required so that the businesses can look not just at tomorrow, but the day after and next year and the year after that. And that helps them manage the risk. Additionally, we've put round that teams. For example, we have a talent team to help them with recruitment. We have a team that helps them, which we call RevOps, which helps them with their sales order management sort of processes. And we put, for the different aspects of the business, we have tools that they can access, which help them manage that risk. And hopefully the result of that is that where businesses go off track, and I talked earlier about, say, the realizations last year, those businesses that we realized that on average said produce a sort of 2x return, overall, at some point or other in the life of those investments, they were valued at or nearly at zero. And the work that we put in, gives the return. You have to work hard to do that and have to sometimes wait a little longer, but it delivered that return. And interestingly, the path that businesses take is never smooth. It's never the plan that they originally achieved. And it's keeping on that plan that helps manage the risk. So, in the last few years, I'd say the last 5 years, we've had one write-off in total where we didn't recover. Everything else we've got some money back from. And that is a feature and a function of, I think, the way that we try to help the businesses achieve some or part of their plan and recover capital for investors where it doesn't go quite as everyone would have liked.
Out of how many investments was that to only have one write-off?
About 45.
It's pretty good going, isn't it?
The past is always never a good guide to the future.
No, so
so we have to keep working hard at that. But yeah, it's something that we're quite proud of.
We mentioned earlier, tough couple of years for venture. How are you finding the environment right now, and where are you seeing the biggest opportunities?
It's a really interesting time, I think, A, to have capital, and B, to be investing, partially because there's slightly less weight of capital around than there was previously. Asset prices are coming down. So, entrepreneurs are recognizing that they have to, maybe perhaps not get the prices they were getting in 2021. And there is a focus on the entrepreneurs on capital efficiency, which is an easy phrase to say, but what it actually means is that they're making investors' money work harder for them and go longer. So if you've got those combinations of things, deployment of capital at the moment, it's a really interesting time, particularly also as those businesses that were told a year or two ago to be more capital efficient have stretched their capital as far as they can. So the good ones that have done the good stuff are coming out to market now. And that's what we're seeing, which is why our inquiry rates are high and why our investment rates are high at the moment. So I think deployment of capital is good, and you've got to be selective, as I mentioned earlier about our realizations, over the assets that you want to realize in the very short term.
So it sounds like everyone's been on a bit of a diet. They've been to the gym and they're looking a little bit trimmer. Is that a way of
It's not entirely how I describe myself just at the minute, but there are trite phrases always wheeled out, which is, never waste a good crisis, never waste a good downturn. But there are definitely things where, as money now has a price and a cost as interest rates have come in, that is forcing some of those behaviors. And ultimately, that does produce a better, efficient, more productive businesses than you might have done at times when capital was somewhat freer.
Yeah. So to sum up, Dave, for those that want to back a VCT this year, why should they be backing the British Smaller Company VCTs?
British Smaller Company Venture Capital Trusts, the reasons I would give are, we have a long-term track record on performance, which I think is strong over any metric that we look at, 1, 3, 5 or 10 years. Consistently paying out dividends to shareholders, maintaining value over a long period of time, producing good returns. We've got an approach that's slightly different to many in terms of the way that we originate and find transactions. We've invested in our team more, so we have over 60 people now in our team in total. So it's probably one of the largest teams in the market, even though our funds are not necessarily the largest. So that's the amount of resource that we put in. And for all of those reasons, I think that's why I picked BSC VCTs this year.
Very good. David Hall of YFM Equity Partners, thank you very much.
Jonathan, my pleasure. Thank you.
If you are watching on YouTube,
please press like and subscribe to the channel for more.